Welcome to today's Explainer. We're going to be diving into a wild one today, decoding those massive 2026 market shifts and the really staggering losses we saw in what used to be our safe haven technology stocks. Over the past few months, the financial world has just watched in total disbelief, right? The very pillars of the Indian IT sector, companies that we've literally always considered the bedrock of stable, predictable growth, they've been shaken to their absolute core. Today, we're going to put a magnifying glass on one specific giant right at the center of this storm. Infosys. So how exactly does a too-big-to-fail Nifty 50 giant lose half of its value? Let's dive right into this mystery. For decades, Infosys wasn't just another stock. It was this incredible compounder, a massive wealth creator, and just a heavyweight champion of the Nifty 50 index. People really saw it as untouchable. But then, in 2026, we witnessed this unprecedented valuation reset. How does a company with such a massive global footprint and these incredibly deep client relationships just watch half of its market value evaporate? Well, to figure that out, we have to look way past the daily market noise and examine the deep, underlying currents pulling the whole sector down. To do that, we're going to peel back the layers of this perfect storm using kind of an iceberg model. We'll be looking at 1. The fall of a giant, 2. Trillion rupee wealth erosion, 3. U.S. macro and Fed headwinds, 4. The generative AI disruption, 5. The AI deflation threat, and 6. Navigating the IT reset. All right, part 1, the fall of a giant. Let's start with the surface-level reality, which is the sudden and dramatic collapse of Infosys, a historically untouchable heavyweight. Just look at the sheer scale of this drop. Up at the peak of the mountain back in December 2024, Infosys shares were riding so high at 2,006 rupees and 45 paise. But fast forward to June 2026, and the stock is trading around 1,006 rupees. Guys, that is a staggering 50% decline from its peak in just a year and a half. It seemed like every single bounce just faced immediate selling pressure. It really left long-term investors questioning the entire foundation of their portfolios. Moving into Section 2, Trillion Rupee Wealth Erosion, let's look at how this share price crash translates into an almost incomprehensible loss of investor capital. The crucial takeaway here isn't just the percentage drop, it's the absolute capital that was destroyed. 4.2 lakh crore rupees. This massive number really anchors the reality of the situation. A jaw-dropping 4.2 lakh crore rupees in wealth was absolutely wiped out from the market capitalization of Infosys alone. Think about that. The company's market cap slid from over 8.3 lakh crore rupees all the way down to roughly 4.08 lakh crore. When we're talking about wealth erosion of this magnitude, we're not just looking at some technical correction, we are talking about a fundamental repricing of their future earnings potential. But here's the kicker. Infosys wasn't alone in this freefall. Blue-chip peers like TCS, Wipro, and LTI-Mindtree, they also hit multi-year lows. We actually saw a mega carnage that erased nearly 19.28 lakh crore rupees across the top 10 IT firms. The entire Nifty IT index shed over 25% in 2026. It was literally the weakest among all key sectoral indices. So what does this tell us? It tells us the problem isn't isolated to Infosys's management or execution. No, this is a systemic, sector-wide crisis. Which brings us to Section 3, U.S. macro and Fed headwinds. We need to look just below the surface at these cyclical macroeconomic currents that were dragging the sector down. So the first wave of pressure actually came from the global macroeconomic environment, specifically over in the United States, which, as we know, is the primary revenue engine for Indian IT. A persistently hawkish U.S. Federal Reserve, coupled with the looming threat of continued rate hikes, really forced American corporations to tighten their belts. Discretionary IT projects, those were the first things to get delayed. But the real shockwave, the one that rattled everyone, hit on June 18, 2026. That's when global enterprise giant Accenture slashed its full-year revenue growth forecast to a measly 3 to 4%. Accenture's stock crashed 18% in a single day on Wall Street. That acted as a massive red flag for global IT spending, and it immediately triggered a sympathy sell-off in Indian IT names like Infosys. This quote from Enkar Punj at Equirus Wealth beautifully summarizes the sentiment at this stage. Investors weren't just reacting to past earnings anymore. They were looking at the road ahead and seeing this dense fog of uncertainty. Tighter corporate budgets meant fewer new deal wins, huge delays in closing existing pipelines, and just severe near-term earnings uncertainty. The market, which usually pays a nice premium for those predictable cash flows of IT companies, suddenly demanded a sharp discount. But listen, cyclical macroeconomic headwinds are really only part of the story, right? Recessions come and go. Now, let's dive deep underwater to Section 4, the generative AI disruption, which is a structural and, frankly, existential threat. This right here is where the narrative shifts from a temporary slowdown to a permanent industry reset. For decades, Indian IT, led by pioneers like Infosys, relied heavily on a highly predictable labor arbitrage model. The formula was super simple. Recruit thousands of engineers, train them for repetitive tasks, deploy them on maintenance projects, and then just bill the client for human hours. It was essentially a factory model where your headcount literally equaled your revenue. But the generative AI era, it's breaking that traditional chain completely. AI coding agents and automated workflows are suddenly capable of doing all the heavy lifting. The old outsourcing bottleneck is being completely bypassed by software that doesn't need to bill for human hours. And this is exactly why the market panicked. As experts like Middle Kalawadia point out, this isn't just some passing storm. It is a fundamental re-rating of the sector. When AI alters the competitive dynamics like this, the long-held valuation multiples that companies like Infosys enjoyed are permanently compressed. The market essentially woke up and realized that simply having a massive workforce is no longer the impenetrable moat it once was. That brings us to Section 5, the AI deflation threat. Let's look at exactly how this squeezes traditional outsourcing revenue. Financial analysts are now actually calling this dynamic AI deflation because generative AI does the work so much faster and easily automates high-volume tasks. Clients are waking up. They're looking at their Indian IT partners and saying, hey, wait a minute, if AI is doing 40% of this coding, why am I still paying you the exact same hourly rate for 100% of a human's time? So clients are outright refusing to pay the old rates. This creates a massive deflationary squeeze on IT service revenues. The actual volume of billable hours is shrinking precisely at the same time clients are demanding aggressive price reductions. It's a double whammy. And the institutional reaction to this deflationary threat? Swift and brutal, 7.3%. That incredibly low number right there represents the allocation of foreign institutional investors, or FIIs, to the tech sector in 2026. It plummeted to an all-time low. Smart money realized that these legacy IT service platforms just lack a strong, defensible proprietary moat against global AI platforms right now, and that prompted a massive exit from the sector. Now, take a look at where the money is going instead. Capital isn't just disappearing from the tech world. It's aggressively rotating. Instead of flowing into labor-heavy IT services, institutional money is pivoting directly into the hardware and infrastructure that is actually powering the AI revolution itself. Budgets are shifting heavily to AI infrastructure, cloud data centers, semiconductors, and the cybersecurity needed to protect these vast new data models. Traditional IT services were basically left out in the cold, while the AI gold rush happened entirely elsewhere. Finally, we arrive at Section 6, navigating the IT reset. So, what should retail investors and market watchers take away from this monumental shift in the global technology landscape? First and foremost, you absolutely cannot treat this like a standard cyclical dip where you just blindly buy the historic lows. Investors have to acknowledge this as a structural adjustment. The rules of the game have literally changed. Moving forward, your focus has to be strictly on quality franchises. You need to really dive into these companies' AI roadmaps. Are they just throwing around AI buzzwords, or do they have genuine, scalable AI code delivery partnerships? You want to look for diversified revenue streams that aren't solely reliant on legacy labor arbitrage. And finally, if you are looking to enter or average down, make sure you deploy your capital in measured, highly disciplined tranches rather than just going all in. The 2026 crash of Infosys and its peers is going to go down in history as the moment the IT sector was forced to take a really hard look in the mirror. I'm going to leave you to ponder this final question as we wrap up today's explainer. Is this the end of Indian IT as we know it, or is it just the painful birth of its next evolution? It's definitely a stark reminder that we need to rethink exactly how value is going to be created and captured in tomorrow's AI-driven economy. Thank you so much for joining me today, and as always, keep questioning the surface.